Hi there. If you're a finance professional, you know that navigating the world of accounting can be complex. Today, let's break down how to apply generally accepted accounting principles, or GAAP, to various accounting transactions and events. First up, revenue recognition. Under GAAP, revenue is recognized when it's earned and realizable, not necessarily when cash is received. For example, if a software company sells a subscription service for $1,200 upfront for a year, they should recognize $100 as revenue each month. This aligns revenue with the period the service is provided. Next, expense recognition, also known as the matching principle. Expenses should be recognized in the period they're incurred and matched with the revenues they help generate. Imagine a manufacturing company incurs $50,000 in production costs for goods sold in December. Even if they pay in January, GAAP mandates that the expense be recorded in December. Now let's talk inventory valuation. Inventory should be recorded at the lower of cost or market value, following the lower of cost or market rule. For instance, if a retail company buys inventory for $10,000 but the market value drops to $8,000, they should write down the inventory to $8,000. When it comes to depreciation of fixed assets, GAAP requires these to be depreciated over their useful lives. Say, a company buys a machine for $100,000 with a 10-year useful life. Using the straight-line method, they'd recognize $10,000 as depreciation expense each year. For accounts receivable and bad debt, companies should recognize accounts receivable at their net realizable value. If a company has $50,000 in accounts receivable but estimates 5% may be uncollectible, they should record an allowance for doubtful accounts of $2,500, reducing net accounts receivable to $47,500. Lease accounting is another key area. Leases are classified as either operating or finance leases. If a lease transfers substantially all the risks and rewards of ownership, it's a finance lease. Otherwise, it's an operating lease. Moving on to contingent liabilities, these should be recognized if they are probable and the amount can be reasonably estimated. If a company is likely to lose a lawsuit with an estimated loss of $100,000, GAAP requires this to be recognized as a liability. Regarding foreign currency transactions, these should be recorded at the exchange rate on the transaction date. If a US company buys goods for 100,000 euros when the rate is 1.2 USD EUR, it's recorded at $120,000. Any rate changes before payment result in a foreign exchange gain or loss. For impairment of assets, an asset is impaired when its carrying amount exceeds its recoverable amount. If a piece of equipment's carrying amount is $500,000 but its recoverable amount drops to $340,000, an impairment loss of $160,000 should be recognized. Finally, consolidation of financial statements. A parent company must consolidate the financials of its subsidiaries as if they were a single entity. For example, if a parent company owns 80% of a subsidiary, it consolidates 100% of the subsidiary's financials, with a 20% non-controlling interest reported separately. So, by following these GAAP principles, companies can ensure their financial reporting is accurate, consistent, and transparent. This provides stakeholders with reliable information for making informed decisions. Thanks for watching, and don't forget to like and subscribe for more finance tips.